Hello everyone, and welcome back to another exciting online talk from the Oxford Guild with our Collegium Global Network and our partner societies from leading universities. Today, we're delighted to be hosting a special online event with John Mousseau, CFA. John Mousseau is the president and CEO of Cumberland Advisors, an asset manager responsible for managing over $3 billion in assets. His long, successful career in finance has seen him become a thought leader in fixed income investing and the macroeconomic landscape, appearing in Forbes, Bloomberg, and the New York Times, and serving as chair of the Municipal Bond Buyers Conference. In these times of global economic crisis and huge volatility in the financial markets, John Mousseau will be sharing his huge wealth of experience and giving us his insights into the latest developments. So first off, he'll start with a market overview, and then he'll move on to an audience Q&A. Thank you very much, John, for joining us today and sharing your time, and over to you.
Thank you very much, and I really appreciate everybody joining. Thank you, Harry Lindsay, for making this happen. I'm honored to be here, and what Harry just said is what I'm going to try to do is kind of cover the markets in general. Most of what we manage at Cumberland is bonds, but I have some slides towards the end talking about equities. Try to keep it at a high level and talk about markets, what the Federal Reserve has meant to the markets, where we are now and where we see ourselves going, because the one thing that we have seen in this country is that the results of the pandemic have been anything but static, right? So you had the great sell-off, you had a recovery of markets, you've had some fall off in markets, but now you've also seen a resumption, particularly in the southern states in the US, of the pandemic. And whether this is a phase 2 or a continuation of phase 1, which is probably more likely, that has impacts for it too. And it's interesting, and I'll just say this as an overview before we start, is that in this country, in the US, if you go back to 1918, which was the Spanish flu, and the country lost well over 300,000 people, 360,000, I think. So percentage-wise, a huge amount. It's interesting because there clearly was social distancing in the sense that people were wearing masks and trying to do stuff, but they never shut down the economy. Number one, because the country had just gone into World War I, fighting Germany, and starting at the end of 17 and beginning of 18, sending armaments and troops. And so they never shut down the economy, which probably absolutely hurt the number of people that passed away for sure. But with the economy not shutting down, you saw a stock market that did extremely well in 1918 for that reason alone. So it's an interesting, a poor outcome from a health standpoint, but an economic outcome which never really blipped. Harry, if you could go to the first slide, that would be great. One more, sorry. Thank you. Ladies and gentlemen, I'm using our municipal bond yield curve here, but this could substitute for corporates as well. And it's the idea, and I'm going to march it through the timeline of what happened. If you walked in the door on March 9th, you saw Treasury prices spiking up 9 points. They had been as high as 15 points higher. What was going on? That was very simple. You saw the Saudis selling oil and buying Treasury bonds. And it was as simple as that. What it meant to the markets here and other places was the fact that with Treasury prices climbing so much, it meant that none of the dealers, whether in corporate bonds or municipal bonds, could hedge. Because if they decided to sell Treasury futures against what they were buying, they got very much hurt because prices were rising. Because remember, if you're hedging, you're actually short Treasuries. So what they did is they withdrew their bids. They brought their bids back. That meant that prices were lower at the end of the day. That started a cascade of municipal bond and corporate bond funds selling, which continued unabated for about 9 business days to the 9th to the 20th. And then by the time the 24th came, it totally reversed, about 2/3 reversed in about 4 business days. And I'll talk a little bit about the Fed's role in that, but essentially high net worth investors moved into a realm where the funds had essentially abdicated and sold off. And you can see this from this graph. You can see the orange line is the beginning of the year, and you can see how muni yields climbed up to where they were on March 20th, a huge amount. And of course, here you are now on June 26th, and yields are lower than they were on March 9th, which is basically a way of saying that the Fed has done their job by providing support. We'll talk a little bit about that in a second. Harry, if you go to the next slide, please. A little different on the Treasury curve. Here's the Treasury curve at the beginning of the year, and that's the line at the top. And of course, what did we see as you started to see the stock market erode? That started at the beginning of March and picked up after that March 9th. And you saw it really continue unabated till March 24th when it made a low. But in all that time period, you saw what you always see during times of stress, and that is markets moving to the safety of U.S. Treasuries, the most liquid instrument in the world, and one that is there for safety. And really, people pay less attention to yield and a lot more attention to the fact that it's safe. So there you were on March 20th, and here you are on June 26th with basically intermediate yields lower even than where they were on March 20th. So the story on this has been muni and corporate yields moved higher. Yields on everything else came back down. Treasury yields moved back down and have stayed back down. And that will probably continue because, as we'll see, the Fed is on a course where they are really providing unlimited amounts of liquidity to the market. And the model that we believe at Cumberland we're using for this is World War II. And if you are a historian and go back to World War II, what you saw was the Federal Reserve, they kept the 10-year Treasury bond at 2% through the whole war. So if yields climbed a little bit, they bought bonds. If yields declined more than 2%, they sold bonds. And they basically kept it at 2% from 1942 right through the end of the war in 1945. And if you can go to not the next slide, but go to the slide after that. There you go. These are what I have called the 5 or 6 horsemen of bond debacles. And I won't go through them all, but I'll briefly describe them. And you see these peaks and sell-offs in the market, and that's the 2008 financial crisis. We had a crisis in this country where we had a bank analyst predicting that all state and local governments would be going bankrupt in 2011. That's the Meredith Whitney sell-off. We have the taper tantrum of 2013 when the Fed started to imply that they would be less accommodating going forward. They only talked about it in general terms. It didn't matter. The market sold off anyway. We can see a sell-off, and we see the big dip in yields in Brexit because when Brexit happened, everyone thought the end of the world was coming, and and it's funny with all the COVID stuff. The last thing anyone's talking about today is Brexit. We have the Trump sell-off, we have the fear of the Fed in 2018, and we have the COVID sell-off, of course, this year. The one thing that's remarkable about all of these sell-offs in the bond markets away from treasuries is that the yields are increasing, and they're increasing at an increasing rate, which is almost always a sign for a bond manager to start extending maturities and locking in these higher yields. Because as we've seen, all of these markets have repaired themselves. And usually the repair, if you just took a line and looked, the repair takes longer than the sell-off, but indeed they repair and they've moved to lower yields over cycles. And that's important because, as we're going to see, we're going to talk about the longer bond market cycles and where we are in a later slide. If you go to the next slide, Harry, please. This is true of corporate bond funds as well, but look at the flows, and you can see that the inflows that you see above the line tend to be the ammunition for outflows when things turn sour. So if you looked at last year, you saw a tremendous amount of inflows. And I can remember saying to my colleagues, I worry about the bond market selling off because there's so much hot money in the market relative to the inflows. Not dreaming that the sell-off would be caused by a virus, but indeed it was. And we can see the sell-off here, and it was dramatic. And it is unlike anything that we've seen in the last 10 years on the order of magnitude of 4 or 5 times. And that was liquidity. That was not a sell-off, people thinking like, oh my God, credit is going to hell, erosion of state and local governments or corporations. What this was a sell-off of people wanting cash because the stock market was imploding. And it didn't matter whether it was a REIT, didn't matter whether it was a corporate bond, a municipal bond, a mortgage-backed bond. They were selling everything. And you can see the depth of the selling. Harry, next slide. You can see the left-hand side shows all the selling, and you can see the right-hand side. You can see we've now seen a resumption of flows into bond funds. That's a positive sign for now. It isn't wildly positive to offset the negatives, but the fact that it's not outflows is a good sign. Harry, the next slide. Very important, this slide. This is the yield on the 10-year U.S. Treasury bond. And you can see the dramatic drop, and we hit a 0.3% during the carnage around March 9th. And that was during the Saudi selling of oil and buying of Treasury securities. And you can see the rebound off of that. That was as the Fed got involved. And we'll see more about the Fed and what they've done. But in the middle of the bond sell-offs, the Fed stepped in a number of different ways in this country, and on a very proactive basis. So the first thing they did is they shored up the money market funds in this country by promising to buy paper that the money market funds could not get bids on. So whether it was commercial paper in the corporate side or tax anticipation notes on the municipal side, they went in and said, we will buy your notes, you, the money market fund, at your cost. And the problem was there was no liquidity. So if somebody went to sell, a Maryland tax anticipation note, which the money market funds live on these revenue and tax and bond anticipation notes, there was no bid. Why was there no bid? Because of the liquidity concerns. So a 2-month, 3-month piece of paper might have been selling at 97 cents on the dollar, which would have been about a 12% yield. That's crazy. So they went in and said, look, we'll buy your notes at your cost. And therefore you can take that money and use it for redemptions or buy treasuries or whatever you want to do. What that did was it shored up the money market funds and kept the money market funds from having a run on them. Very important. So you see yields spiked back up, and now they've come down to somewhat lower levels. If you go to the next slide, Harry, this shows you the volatility that we've seen in the bond market with treasuries. It has been anything but small. And it's funny because rates are so low, volatility tends to be high. I mean, it's just do the math. If you're sitting there at a 0.3 yield, and you go suddenly to a 1% yield, which is 3 times the rate that you had before, that is high volatility. So one of the things that comes with low interest rates are high volatility of bond yields. And it's people that, if you're in the bond market, it's something you have to get used to. Harry, if you go to the next slide. The next 2 slides we think are very important. And they measure the difference between a 2-year bond and a 10-year bond. And as we'll see on the next slide, a 2-year bond and a 30-year bond. Why these slides are important as you see those rates climbing. And if you went all the way back to last August and September on these graphs, you can see how low those yields were. So if you think about it, you were almost at 0 on the 2s to 10s, and you were only at about 40 on the 2s to 30s. What that was saying back in the fall was, oh my God, we're very concerned about rates in general. Why? That's because US rates were coming down, catching up with rates that were in Europe, which were low. And our thought is the negative rates, which are still in the front end of the yield curves in Europe are a mistake. And they were certainly a mistake on the longer end. And the reason we think negative interest rates don't work is the fact that they don't really help the banks. And you think about it, and when you had these very low differences between a 2-year bond and a 10-year bond, that's called a flat yield curve. A lot of people think that a flat yield curve is a portend or predictor of a recession. And our opinion is that no, they actually cause a recession. And the reason is simple, is that if you have a flat yield curve and there's no difference between shorter term rates and longer term rates, the banks can't make money. They can't borrow short and lend long. So if the banks cannot make money by lending, what do? Well, they restrict credit to only their best customers. So then you get a credit squeeze, and yield spreads start to expand because certain clients can't get credit. We didn't think that was the case last fall. And the reason is that it was caused, this flat yield curve was caused by longer term interest rates coming down, not by shorter term interest rates rising, which is the traditional way that it occurs. The Fed raising rates to slow an economy, and eventually they get to the same level as long-term rates. And by that time, you've slowed the economy. This was a different mindset because of what was going on in Europe. So we thought this would reverse, and indeed it did. And here you are, even going through COVID, and yet the yield curves are very positive. A positive yield curve is a very good predictor of an economy that's going to do well. And the reason is that people are demanding higher yield for going longer because they expect some inflation. They expect business conditions to continue to improve. So from where we sit, this is a positive sign. You go to the next page, Harry. You can see this is investment grade corporate spreads. Tells you the same story as we saw on the municipal front. Look at that spike in yields. And it was very short-lived. And lots of people moved into this space. I know we were one of them. We usually buy in our taxable portfolios only about, call it 10%, 15% in corporate bonds at most. We upped that during this spike. And the reason is they were giving away very high-grade companies at spreads that were 100, 150 higher over treasuries than they were the week before. Again, all liquidity driven. And you can see that with the Fed programs and the stability that's been brought to the market, those corporate spreads have come down. They've leveled off a little bit at about 150 basis points over treasuries. But when they were 300 over, there aren't too many giveaways in life. This was one of them. A little bit about inflation. Harry, if you go to the next one, thank you. This measures the 10-year Treasury and core inflation. Both have rolled over and played dead. Back to last year, you can see the drop in the Treasury yield, and it went below CPI. And that happened, call it spring of 19. I like to think we're good bond managers. We weren't so good here. We started bringing our durations and making our portfolios more defensive as yields dropped there. That paid off when COVID sent yields on everything else higher. We used that defensiveness to our advantage and used the ammunition. But our thought process was just like if you went back to 2016 on this graph, you can see, again, at that point, yields had dropped significantly below the rate of inflation. And think about it from a common sense standpoint. If you are getting paid a yield significantly below the rate of inflation, so you have a negative real yield, how much interest rate risk do you really want to take in that kind of an environment? And as we saw at the end of 16, look how yields popped back up. That was after the president got elected. And we saw yields go up again in 2018 as the Fed started to raise interest rates. And of course, they've done nothing but come down since, between the Fed cutting rates last year and then COVID taking over. Inflation has died down with this. Ladies and gentlemen, I would submit, though, between the fiscal stimulus that we've seen and the monetary stimulus, which isn't as inflationary, as you would think. I think you will see some inflation. It won't be this year. It may not even be next year. But if we don't see some inflation out of all the $2 trillion of spending, and that's just the U.S., it's hard to believe that you'll see inflation, at least in the rest of my lifetime. It's pretty simple why you don't have inflation on the monetary side. And I'll give you a quick example. If you are the Fed and you're buying $100 million of treasuries, and you're buying them from the Bank of Harry, and you deposited $100 million into the Bank of Harry, what happens? Well, treasury prices go up a little bit. The yields on treasury prices go down a little bit. And what happens at the end of the day at 2:15 at the Bank of Harry? The Bank of Harry has $100 million that they end up putting back to the Fed on their balance sheet, earning 0.25% of interest. The one thing that hasn't happened is the Bank of Harry has not lent out that money. So if you don't have money being lent out and the velocity of money being created there, then you really don't have inflation. It's a lot different on the fiscal side when I'm giving money away to people to spend. That has an inflation component, as we'll see. Harry, next slide, please. Here, ladies and gentlemen, you can see the U.S. federal deficit. It made a lot of headway back starting in 2012, and that's because under the Obama administration, you saw, number one, tax rates go up, so that increased revenues, and you saw spending go down because Congress in this country couldn't agree on a budget. So what did they do? They went to what they called sequestration, which meant that if you can't agree on a budget, then we'll have an automatic 7% cut in all non-essential services. So not defense, not welfare checks, but parks, national parks being closed down, things of that nature. So, or not closed down, but reduced hours. So indeed, you saw the deficit go from $1.4 trillion down to the 0.4. We took $1 trillion off the annual deficit. That has all changed around, partly under this administration, which has spent money with a tax cut, and now is spending money. And you could probably drop this line, which shows you at $1.8 trillion, and it will go well past $2 trillion to maybe $2.5 trillion. There is a reckoning point in here, and you're starting to see some of that in the U.S. Senate, which is still in Republican control, and a lot of very conservative senators that are there saying, you know, enough is enough. A lot of people have said we are practicing the no asset left behind Fed mandate, and there's a lot of pendulum swing back because of this. If you go to the next page, Harry. Here you can see this is the U.S. government compared around the world on 2 years and 10-year bonds. So even though our rates are lower, we are still probably in pretty high relative to the rest of the developed world. If you look at Italy, I don't consider them on the same level credit-wise as the U.S. But, you know, if you were in charge of managing a sovereign bond fund and you looked at these yields, you'd say, I got to put some money in U.S. yields. So I think that has continued to play. Harry, why don't you jump ahead 2 slides and go to, keep going. Those 2 slides, ladies and gentlemen, you can look at your leisure. They show you municipal versus corporate default rates and why we like taxable munis in our portfolios here because they're so much better credit quality-wise, but I'll let you go to that. This measures the difference between the 10-year U.S. government bond and the 10-year German bond. That has been wide forever. It is narrowing. If you took this graph and drew it back 50 years, it was never higher than 0.5% one way or the other. It got as high as over 2%, the difference between the two. That has started to narrow. We think this continues to narrow, probably a combination of U.S. yields staying where they are and eventually German and other yields getting higher as you come out of the pandemic. If you go to the next slide, Harry. This is a great slide. It's 57 years of the U.S. 10-year bond. And the reason this is important is we get asked all the time, hey, are we on the other side of this coin? In other words, are we going to be going to a higher secular rise in interest rates where the peaks are higher and the troughs are higher? Because if you drew this graph all the way to 1946, you would have seen just the opposite. From 46 after the end of World War II to 1981, each peak in yields was higher than the last peak, and each trough in yields was higher than the last trough. You spent 39 years doing the reverse now. And each time people think, oh, we're at a higher leg of treasuries, you get a drop down. I would submit, I think we are at the lifetime low in interest rates, and the COVID will probably mark that because it was really a non-economic event in the sense that it wasn't caused by excesses in the economy. The economy was in very good shape going through here. So it was pretty much an act of God, if you will. But I would be surprised if in 2 or 3 years interest rates are not higher for reasons of inflation as well as somewhat of a pullback in government programs. Now, if you can just jump ahead, this shows you the Fed's balance sheet. You can see big pickup towards the end. That's all the assets that they're adding recently. So you've had 3 rounds of quantitative easing, and now you have the last round. Harry, jump ahead 2 slides. Unemployment. Look at the rate of unemployment. Now, when I saw this graph, you had to do a double take and think that this was not the y-axis, and that's why I actually wrote it in there. You've never seen a jump in unemployment. It has already started to decline. We expect it to continue to decline. And what we think happens is you're going to start to see people get back to work. It'll really ramp up as you get to the end of July. That's when a lot of the unemployment claims on the federal level run out here. Very important. Hey, if you could jump ahead by 3 more slides. There you go. Unemployment claims, same thing. Look at that. You're a huge uptick. That has come back down significantly. So you had this gigantic spike. Obviously, people are going back to work. It is by far from cured. It will take a while. One of the maddening aspects here, of course, is that you actually have companies that are having trouble getting people to come back to work because they're making more money on unemployment. That is something to be reckoned with. Again, at the end of July, that takes care of itself. So I would expect to see this continue to trap downward. Jump ahead 2 slides, Harry. Combined central bank balance sheets. We're not the only Fed coming to the rescue here. That's true of the ECB as well. It's also true of the Bank of Japan. Jump ahead, Harry, one more. A little bit about the stock market here. Look at the, and I won't get too technical, but the PE ratios really measure, how people are starting to discount the stock market. And the forward ratio on the S&P 500, and go ahead to the next slide, the S&P value index, or the following slide, S&P 600 index, they are all at this big jump. And the reason's simple, is that the markets right now, the stock markets, do not care about 2020. There are no earnings. They've taken, you think about PE, price over earnings, right? They've taken the E, taken it out behind the bond and shot the E. And the E is not coming back until you get into next year. They are basing these on basically what's going to go on in 21 and going forward. I think this is an important point, is that you have an economic rebound that's more U-shaped. We're going through that now where we're bottoming out. Things are getting better. We're bouncing along. We have a resumption of the virus, and eventually to reach the other side of the U and start to come up. Markets don't look at U's. Markets look at V's. Markets look and start discounting information ahead of the time. That's been true on the bond side. It's also true on the stock side as well. And I think part of that is the fact that the economy was in great shape as you went into this pandemic. So the idea that you can get back to that, not relatively shortly, it might take you longer than people think, but that would imply more of a V-shaped rebound in the stock market, even if you have a U-shaped rebound in the economy. One more slide, Harry, and then I'll take some questions. This is a little complex, but I wanted to throw it in because it's important. This shows you corporate profits as a percentage of the stock market. And we take normalized corporate profits, so we get rid of depreciation, et cetera. And then we look at the whole valuation of the stock market as a percentage of the economy. And as you can see, the stock market, with volatility towards the end there because of the virus, is still well above where corporate profits are. Corporate profits have turned down, and they've significantly turned down now. So what I would expect is to see stocks, you're seeing that now, where there's some coalition around the levels where you are. It goes up a little bit, it goes back down. I would suggest you're probably in this for a while. Corporate profits should turn around, and you should see those two come close together. You can see what it was like back 20 years ago, the NASDAQ bubble. That was the craziest time in the world. You saw stocks like Microsoft back then selling for $120 a share. 20 years later, it's basically at $200 a share, but back then it was a much smaller company. And you also had all sorts of .com stocks that were selling with no earnings, and yet bonds were giving away at 6%. So that was a significant bubble, and you can see it in this graph. Harry, I thought I'd just stop there and take some questions since we're basically at a half hour.
Very much. Thanks, John. Really good overview there of quite a lot of stuff. Particularly really interesting explanation for why the market rally has been so strong, because I know a lot of people have been very, very confused about that. We had, obviously, as you can imagine, a bunch of questions coming in. Questions generally quite broad in their focus, sort of looking at the broader macroeconomy and things. Figured this one would be a decent one to start with, coming from Matt, doing geography at Oxford. And Matt asks, will negative interest rates ever come to America? If so, what do you think the right response to them will be?
Great question. I personally think not. You've heard Jay Powell, the Fed chairman, talk about his aversion to negative interest rates. Our feeling is that they do hurt banks. And let's face it, you can't get a significant sustained rebound without a financial, basically with financial institutions, banks being healthy. One of the reasons that you saw a pretty good leg up in the stock market here was you suddenly saw banks start to do better. Now, they're still a long way from where they were from a valuation standpoint, but the banks are the key. So I don't think you see negative interest rates here. And one of the reasons is I don't think this country, U.S., is psychologically geared up for negative interest rates. Deflation is not in this country's DNA. That could be a holdover from the Great Depression, but I can guarantee you, I think they will look for political change. If you ever saw negative interest rates and deflation in this country, they'll say, "Give us inflation. We don't care what you do." Quite frankly, what things you might want to do is actually raise interest rates, because when you saw in 2018 when the Fed was raising interest rates during the year, go look at the inflation charts. Inflation actually rose, and why? Because when you suddenly have higher short-term interest rates, you create a lot more action in the short-term part of the bond market, and there's more money moving around. And if you increase the velocity of money, you tend to start to see a slight pickup in inflation, because money is moving at a faster rate. And it's funny because it goes against some of the common sense we've all learned in the economics books. If you go back and look at some old papers from Irving Fisher, who was an economist back in the 1930s, that was his prescription. So I'm not a big fan of the Fed holding rates here forever, and nor am I a big fan of negative interest rates.
A question, sort of broader question here, coming from Thomas, doing engineering at Imperial, talking about China. So Thomas asks, what do you think the impact of an increasingly aggressive China is going to be on the macroeconomy?
I think less than people think. Listen, the trade wars are kind of secondary to what's going on the front of the virus. But some of this was already underway. And, I think, quite frankly, you will see China want to try to get to an agreement and probably get to an agreement on tariffs fast. And the reason is that they are fighting that war, and they're also fighting the war that we're seeing on individual rights. You've seen it in Hong Kong. It was quiet for a couple of months during the peak of the pandemic. It has picked up again now that China's kind of back. And they're going to need to come to some accommodation there too. So I don't, and one helps to feed the other. So I think it's important for them to try to get to a settlement on tariffs, and I think they will.
Okay. Question about, dollar dominance, of course, coming from Chiara, doing biochem at KCL. Chiara asks, what are your thoughts about the future of US dollar dominance? Is the COVID-19 crisis going to work to undermine this?
If it is so, it would be temporarily. I think one of the things that you will see coming out of this is that, and if you go back to that chart that I showed you comparing the US to the other countries in Europe, as well as Japan and Switzerland, even with the drop in rates, the US is still higher. I think as you come out of this, that pecking order will probably stay the same. Maybe US rates even go a little bit higher. That will keep dollar demand high. So I don't think it changes very much. I don't think it undermines it on a long-term basis.
Okay. Well, I guess you definitely addressed this one, but it may be interesting to hear more about it. This is one from George doing history at Oxford, saying, as a fixed income investor, what's your take on the current equities rally? Do you think it looks like overconfidence, and have you seen many similarities in the bond markets?
That's a great question, George. And the equities rally is really throwing a lot of people on their heads, because not only because of the rebound, but of the V-shaped part of it. And a lot of people would tell you, and they would have told you this last week, and I know the market's doing okay today so far, but is that you have rarely seen any stock market sell off. And you can go all the way back to 1929, where you haven't seen a bear market leg. In other words, you take another leg down. So in other words, the stock market looks like a W. I would say that if this time it's different because of the quality of the economy going into this. Because the economy was listed, you were at 3.5% unemployment, corporate profits were good. I think the best statistic in this country for the health of the economy was that you started to see a increasing, albeit slight, but an increasing labor participation rate in this country. That is a great sign. That means more and more people are looking for work and getting off the dole and wanting to look for work. That is a great sign. So the economy was in very good shape. That's different than other times when you had fall-offs in stock markets. If you went back to 08, 09, what happened? Well, we had way too high. We had all the mortgage problems where mortgages were being given to everybody from people coming out on parole with no assets to people that, had, gone bankrupt bunches of times, and they were giving them mortgages. So you had that kind of problem. You went back to the valuations you had in the 2000 with the tech bubble. It was crazy. I mean, people were buying stocks like drcoop.com that had no earnings and never had any prospect for earnings. So these had different markets, and this goes all the way back to the 29 crash. I think this one is different because of the nature of the economy going into it, and the fact is that this was inflicted upon us. So a better question is the similarities in the bond market. I think the bond markets are reflecting what's gone on in the stock market. Are they poised for perfection? Yeah, maybe a little too much. We're a little cautious right now on yield spreads on whether it's corporates or municipal yield spreads. And the reason is that this shooting down or collapsing down of spreads hasn't really discounted perhaps some more problems on the economic front if we get a resumption and another wave of the virus. But other than that, and being a little cautious there, I think that you have an economy that, as it bounces back, can do pretty well. And I personally don't think you're going to see a W.
Okay, interesting question here coming in from Shinzi, picking up on how you talked a lot about debt to GDP ratios and just general government debt. Shinzi doing philosophy at LSE. Shinzi says, with debt to GDP ratios in the US over the 100% mark and rising, do you think that it will ever be possible or desirable to pay off this debt?
Probably not in my lifetime, but I think you can make progress for sure. We saw that. People didn't think, if you went back, and admittedly, this was a much different type of environment, right? So you're talking about 20 years ago and going back to the mid-1990s. Alan Greenspan was the Fed chairman. Bill Clinton was the president. But what was interesting about that time period was that you did have a pretty good government deficit. Now, like I said, it was on a magnitude of probably somewhere in the neighborhood of, I don't know, 1/5 of what it is now, if that much. But what did they do? Clinton raised taxes, and he did it. It didn't go crazy. But also what happened was interest rates came down. Basically, Greenspan went to Clinton and said, look, if you make some progress on the deficit, I'll probably be accommodative and get interest rates down, and that'll help the economy grow. That's what happened. You ended up with a surplus. Now, we know what happened to the surplus. You had the meltdown in the economy with the tech bubble. Then you had the war in Iraq. You made a little bit of progress under Obama, a lot of progress under Obama, and got it back. You have fallen off the cliff from this standpoint. I do not buy into the arguments that some have put forth here of this modern monetary theory that you can go on and just self-finance forever, because that works until it doesn't, right? I mean, if there's a point where China or other people say, you know what, we don't want your debt anymore, screw you guys, then suddenly interest rates rise, and they rise significantly. Now, I don't think that happens either, because China does not want to put the vast amount of their existing holdings at risk. But I do think that to show progress, it isn't so much of what the gap is, it's the direction of the gap. So if you show the gap starting to decline, that sends a tremendous message. And I think in this country, whether it's President Trump reelected or Vice President Biden elected, I think tax rates in this country go up, which probably makes tax-free debt in this country a very good buy at some level, because it'll be worth more the day after somebody gets elected, because both of them were going to have to raise taxes at some point. So remember, we have a lot of programs that have been at work there, whether it's the PPP program or the Fed supporting the corporate or municipal bond markets. It goes on and on. I mean, when I say no asset left behind, it's really true.
Yeah, we've got a maybe perhaps slightly tricky question here coming in, but see what you make of it, from Isaac doing maths at Oxford. Isaac asks, what are your opinions on the concept of universal basic income? There's been growing more mainstream support for its introduction in the US, especially in the light of the pandemic.
It's a great question, and it goes far beyond just the economics of it. I think it'll be a topic probably this fall. Those of you who have read Thomas Piketty and his work on income inequality, it's very good, and the growing amount of income inequality does lead to some pretty bad outcomes in other economies. You can go back all the way to the Roman Empire, right? So as a guy who's pretty much a free markets guy, I'm surprised I'm saying this. I think you'll see something in there. What that number should be will be subject, but I can see the concept coming up. And if the idea is that between some higher taxes on the wealthy and maybe a UBI, you start to reverse that gap. And what I don't want to see this country is to be in a combination of class warfare and racial warfare, because that doesn't help anybody.
Great. Question here more about you, coming from Bauner doing economics at UCL. Bauner asks, what made you want to work in bond investing as opposed to equities?
It's a great question, and I'll give you the answer. My first job on Wall Street was working for a company called the Value Line Investment Survey. It's still around. It ranks stocks on a model, and your job as an assistant securities analyst was to write stock commentary to fit the model that they predicted. And it was based on earnings momentum and relative values of PEs to the market, et cetera. The real question is that I could predict earnings on companies very well. And Value Line was great at teaching you how to read a balance sheet and an income statement, because I'm an economist by training, even though I've never really practiced as an economist. And I could never figure out why the hell a stock would go up or down, even though I had the earnings pegged. Because you could have earnings pegged, nice growth, stock gets hurt. Why? So in the end, as I ended up doing work for some other firms, I ended up in bonds, and bonds being tied together mathematically always made a lot more sense, because all bond values are generally rising or falling. Not true all the time, as we saw with treasuries and everything else during the pandemic, but generally speaking, that is the case. It's just at different rates, depending on quality of bonds, depending on where you are on the yield curve. So it always made much more sense to me mathematically than the equity markets ever did. And I'm glad I made that decision, because I made that decision, pretty much 35 years ago, and I've never looked back. 38 years ago, and never looked back. Great question, though.
Yeah, we've got a question actually on this, on the same topic, which we think might work quite well as a follow-up. The question here from Min doing history at Warwick. Min asks, bond investors and equity investors have many inherent differences, or is the apocryphal story that people choose bonds to avoid being harassed for stock tips all there is to it?
It's a great question. Let me just read it again. Listen, the answer is yes, they have many inherent differences. It doesn't mean that one side doesn't leak over to the other. I have a very good client who's been a client of Cumberland predating me, and that's 20 years ago. And he has never owned any equities at all, because he's very scared, always been scared, and owned nothing but tax-free bonds. And he owned them starting at 7%, and he owns them today at 2 and change, and has watched yields come down. After the 2008-09 sell-off, he actually took a little bit of money and put it into stocks for the reason that he looked at it and said, these are all well-known companies, and if they go out of business, we're in a hell of a lot of trouble. That means bonds will be worth even that much more. But assuming they survive, their dividends are paying more than bonds are. So basically, he just looked at his equities as bonds. And so that was the leakage from the bond guy into the equity market. What you saw also, and go back to that same time period, is you saw yields on things, not treasuries, after the sell-off. And this isn't unlike what we saw, but a much briefer period of time during COVID in March. You saw yields skyrocket, right, on corporates. Same thing back then. We saw the Build America Bonds program, and you saw taxable municipal bonds of AA and AAA quality. at 300 basis points, all the way up to almost 400 basis points over treasuries. What that says is that, wow, if you're going to have not only this higher yield, but capital gains due to the narrowing of this yield, and then furthermore, most of these bonds are non-callable, so they have the convexity to act like treasury and without the call feature, with appreciation as yields come down, that appealed to equity investors. So we saw people that were mostly equity investors said, hey, can I set up a Build America bonds portfolio or the like? So there you had equity people moving into bonds because they had equity-like characteristics in terms of potential returns. So when you get to extremes, that's what you have.
Interesting. We've got another question here from someone asking, again, pushing the angle of career paths, from Liv doing natural sciences at Cambridge. Liv asks, what steps would you recommend for a student looking to go into a career in investment management?
Excellent question. Two things. Read the Financial Times and the Wall Street Journal as often as you can, if not every day. Also, I can't stress this enough. I would also look to do the CFA program. And I will tell you that for myself, I started the CFA program in 1989. I was 32 years old when I started it. I had one daughter that was born right after I took the first exam, and I didn't pass them every year. I failed one year. And by that point, I was saying, wow, I better pass it the next year because by then I'll have a third kid on the way, and I doubt I'll have the time for studying. But I'll tell you, it was the best investment I ever made in myself from a time management standpoint to put in time to study because of what I learned. And the reason I say that is that when I finished it in 1992, as a bond guy, I was one of the few bond people I knew that had a CFA. Now, a lot of bond people have the CFA, but I think today, no matter what you're looking for a job, having a CFA puts you into pile A. And I've always said to people in this country, if you want to stay in investment management or do investment management, it is by far, I think, the best thing you can do. You can go out and get an MBA. And if you get an MBA from a top school, that might suffice. But I don't think it replaces the hard knowledge that you learn in the CFA. And I know I see it through my middle daughter, who is in the middle of the CFA program now. And I know it's a hell of a lot harder now than it was 30 years ago. But I can't underscore how important it is.
That's great. Here's another question about inflation. I suppose it's now asking you to make a prediction. So I guess a different tack. But this is coming from Rahul doing economics and management at Oxford. Rahul asks, what do you think lies ahead for the future of inflation?
It's a great question. As I said, if you look at what's going on in this country between the PPP program, which gave you loans to lots of smaller businesses and even some bigger businesses with a forgiveness aspect of it, or you look at the credit facilities that are out there for not only municipal debt, but corporate debt. And those establishment of those facilities, without even them buying a bond, helped to cure the bond market back in March. Just the fact that the Fed was setting them up sent a message like, hey, we've got your back. So you worry about, is there too much moral coverage, if you will, out there? But at the same time, when you look at the spending that's gone on, particularly on the fiscal side, as I said before, if you don't see inflation in our lifetime, at this time, I don't know if you will see it again. That bond chart that I showed you, 57 years of the government bond, it's actually almost a story about inflation, because when Paul Volcker came in, and God rest his soul, he just died last year. When he came in 1979 as the Fed chairman, inflation was running rampant. It was like 12%. It's crazy. Government bond yields were like, 15, 16%. Tax-free bond yields were like 15%. Corporate bond yields were 17, 18%. Mortgages, if you got a mortgage, it could be as high as 20%. He needed to cure that. So he needed to break the back of inflation. It takes a long time. And a lot of it's based on expectations. And now you're in the case where people's expectation is you're not going to have any inflation. So I would submit that if you hadn't had the pandemic, I think you were heading towards some higher inflation. This clearly delays that by 2 or 3 years. But I do start to think that you start to see some inflation pick up down the road. And the reason I say that is that what have you had happen with the pandemic? You have had supply chains disrupted, but you've also seen, in addition to the disruption of the supply chain, you've seen the resumption of demand. Now, it hasn't been universal and the like, but I think as you come out of this, you're going to see certain goods and things provided, and you're going to see suddenly a pickup. I'll give you one example, and it's an example. Let's talk about housing. In this country, the most desirable homes for the last few years have been homes that have been based on train lines into cities. People wanted to live in cities or near cities. The homes that were out in the hinterlands that were very much in vogue 20 or 25 years ago, where you didn't see your neighbor or didn't have, lots of land, nobody wanted them. So you actually saw homes in this country out in suburban New Jersey and New York selling, and I mean off of the train lines way out, selling for, 2/3 of what they might have sold for 20 years ago. I mean, that's an awful hedge against inflation when you think that most people count on their homes as a hedge against inflation. That all turned around, and it turned around on a dime in the pandemic because suddenly people said, I don't want to be near anybody. I want to live out in the country. I don't want to see people, and I want to have plenty of room for an office. And you had homes that suddenly, now they're in demand, and for 6 or 7 years more, you couldn't give them away, and suddenly, boom, it turned around on a dime. Those kind of things. And so you had inflation. You've had rampant inflation in those homes over the last 3 months or 4 months. You will see that in other goods and services as you go forward. So that is, of course, the disruption of the supply chain. So I do think you'll see some inflation, and it'll be in different goods at different times.
Question here about money printing coming from Dan, doing accounting and finance at the LSE. Dan asks, attitudes towards printing money appear to have shifted, and governments feel a lot more comfortable doing so than 12 years ago. Do you see any downsides to this?
Yes, because basically you're taking the modern monetary theory that you've seen here, and that's an extension of it. So governments may feel more comfortable. The downside is the people's acceptance of their debt. At what point does it become out of control? The fact is you've done a lot of printing of money. Let's take this a step further. Think about the printing of money and thinking about the Federal Reserve having stepped in and buying not only some municipal debt, but also buying corporate debt. And the Fed just put out a list of the corporations that they're buying the debt in. By definition, that's kind of a backstop, right? You should think highly of those companies' stocks. My point is, does it become a chance where the Fed suddenly buys shares of corporations? We've seen this in Japan. Japan's been doing it for years. What happens if the Fed does this? Do the more liberal elements in the U.S. Congress say, hey, now the Fed owns part of, say, United Airlines. We, Congress, want to say on who's on the board of United Airlines. You can see that coming a mile away if the Fed starts this. So the answer to this is that I feel the downside of that is a risk to capitalism, and so I do think they feel more comfortable, but I think that, like most things, this works its way out over a few years.
That makes sense. Question about long-term bond investing from Mary, doing chemistry at Imperial. Mary says, Warren Buffett has famously said that long-term bonds are a very unattractive investment. Are you inclined to agree?
Well, let's face it, I would say this about bonds in general. And this is coming from a bond guy. It's like the old thing about dogs. There's no bad bonds. There's only bad bond prices. And, you know, you could have said the statement that Warren Buffett said, and you could have said it last year. And if you got out of bonds, you missed a heck of an opportunity because yields came down. Now, they came down for reasons that we didn't know the Fed was going to do what they did. But look at they suddenly yields shot up again in March. So the best thing you could buy in bonds was buy long-term bonds because of the potential capital gains to return. I mean, I think what you need, the thing to keep in mind through all of this is that nothing is universal, right? In other words, things, spreads, et cetera, revert to means over time. And that's a crux of what we do, is called a total return bond management. So we adjust durations and maturities in portfolios over time. We were defensive. We got more aggressive. I can tell you that where yields are now, we're probably going to get a little more defensive again. And that's all been in the last 4 months alone. So I don't think you can take long-term bonds, put them aside and say, I'm going to hold these till maturity. So that's another way of saying that if you're a bond investor, whether it's a municipal credit or a corporate credit or sovereign credit around the world, there should be no bond that you buy from a credit perspective that isn't appropriate to hold to maturity. But you should never have any expectations that you would own it to maturity, because bond prices are always changing. Relative bond prices are always changing, and I would say that you should be more active in a bond portfolio. More active in a bond portfolio than anything else.
Okay, great. Question sort of addressing equities, I suppose, now coming from Oscar, doing PP at Oxford. Oscar says, do you see tech stocks such as FANG stocks and others like Zoom, Twilio, DocuSign continuing to outperform? They've driven so much of recent market growth, but will it stop soon?
Sure. I mean, let's put it this way. When you can have fans attending the English Premier League games, that's when I won't want to own those stocks. I mean, that sounds simplistic, but I mean, I think that's the idea. Once you get back to normal, that's when you start seeing the reversion of the mean. But I would take the exception. I think DocuSign, which was doing very well even before this, DocuSign is an important component of going paperless on everything that we're trying to do, whether it's opening a new account or transferring an account or whatever. But I mean, these things will run their course. I mean, I will turn around and ask the question, is there anybody, and I've enjoyed today as much, and one of the benefits is this, I could never do this right without this technology. So I am thankful for all of that. But for everybody that's had to do all of their meetings, or whether you're interviewing for a job or doing a course or whatever, it's hard for me to believe that you're not going to see some Zoom fatigue set in if it hasn't already.
Yeah, I think there is a danger of Zoom fatigue. Speaking of, I think maybe three or four more questions. Do you think that sounds about right? You're conscious of your time.
Sure.
Okay, brilliant. So next question coming from Jan doing PP at KCL. Jan asks, what is your view on the future of ETFs? So there's exchange traded funds. Also this year, more actively managed ETFs for the first time have launched in the US than index trackers. What are your thoughts on active ETFs?
Well, we're a big believer in ETFs in general. So at our firm, the equities that we manage, for the most part, not all, but for the most part, all the strategies employ ETFs, whether a balanced account or strictly equity account. And our philosophy has always been that the great thing about ETFs is you avoid the torpedoes, right? But you can make sector bets and have broad economic themes and bets, and it's a good way to place them. And our emergence of using ETFs goes all the way back to the financial, to the sellout, well, basically to the tech bubble, when we had people taking money out of the firm, which is primarily all bonds, and say, hey, if you guys had an equity product, we'd leave some of the money in your firm. This is when I told you Microsoft was selling for $1.20 and you had bond yields, you had 6. So that was a sign you should be selling all your stocks and buying bonds. But that's when we started to manage money using ETFs. Back at the time, they only had the broad indices, the Russell, the S&P 500, the Dow, et cetera. Now, of course, we have a gazillion of them. I think the idea of active ETFs are, the A, there's probably too many, but B, the idea of active management, I think is probably going to move more to the forefront again, away from the indexers. And the reason it goes back to the other question, you're in a land where technology is suddenly much more to the forefront and going to have a much bigger impact on things, and particularly as it relates to living in the pandemic or post-pandemic. So, yeah, I mean, I think the idea is to stay with the better names and not get too lost in some of the really esoteric ones.
Okay, yeah, quite a broad question about the macroeconomy and potential future developments here from Anne, who's doing classics at Cambridge. Anne asks, just how much of a disaster would the collapse of the European Union be for the macroeconomy as we know it?
That is a great question. I'm a big believer in the European Union. At the margin, I think Brexit was a mistake, but I don't think it was a fatal mistake at all. I think you can try to live with it. I mean, I think one of the, if you think about it, one of the problems with the European Union is the lack of discipline that financial markets formerly imposed on countries that are now being supposedly discipline was being administered by the countries themselves. And think about Greece. If you had Greece, which had all of these economic issues, and a lot of them of their own making, some not of their own making, what would have happened pre-European Union? Well, the drachma would have sold off to a very low price. Lots of money would move in buying Greek assets at very low prices. And the whole thing has a self-correcting mechanism to it that is not enjoyed now, because if Greece sees Germany, and believe me, people still have long memories going back to plenty of wars, Greece sees Germany as trying to dictate terms, and their first reaction is to shun that and to go a different direction. So I think the European Union should be kept. I think it needs some improvement. When Brexit happened, and I have some friends in England that actually said, yeah, Brexit's going to pass. And I was like, how the hell is that going to pass? And they were simple. They had uncles or relatives or cousins that were dock workers or things of that nature and they've been losing jobs and seeing conditions erode and stuff like that. And they said, yeah, it's going to pass. And I think those are the things that needed addressing. We'll see how Britain does out of this. I wish them nothing but the best, of course. I think the European Union, to undo itself, it would be a short-term disaster, but I have plenty of faith in economics in general and don't think it would be the end of all things.
Okay. Here's a question from Jacqueline doing medicine at UCL, which is, I suppose, a few questions in one. She's asking, do you have any predictions on the length of the current financial crisis? When do you expect to see a recovery? And what do you think are the best investment opportunities at the moment?
The financial crisis, right? So, I mean, you'd have a hard time predicting a financial crisis when the S&P 500 is hardly any different than it was last October, and is not too far from where it was at the beginning of the year. So from a financial crisis itself, asset-wise, not that much of a crisis. From a crisis economically, we're in a crisis. I see this lasting probably the rest of this year, but I do see a bounce back. I mean, it's all when the recovery is the same thing as getting a vaccine. You think about it and you say, okay, if you had a vaccine, how soon would it be till you saw soccer stadiums at capacity again? I think very short amount of time. I think that flip over into the back to normal can happen very fast. It's funny, as here in this country, it seems like Vice President Biden is going to win the election, but you don't know, right? You still got 4 months to go. And I said to someone here, I said, you know what? I said, if you actually had a college football season in the United States, I'd give Trump even odds to get reelected. If you don't have it, I don't think he has a chance. And basically what I'm saying is that for a lot of people, sports represents a normalcy in their lives. And I'm using that as a symbol, but it could be other things. But when you get that normalcy, people look differently at things. So to answer the last part of the question is, yes, I expect to see a recovery towards the end of this year. What do you think are the best investment opportunities? The best investment opportunities are the things that you would think about if you were back in the regular world. Are the Zooms already been fully priced? Yeah, probably so. What's the one thing that you had in the regular world pre-pandemic that's gotten absolutely decimated from an equity standpoint? That would be airlines, right? I mean, Warren Buffett famously said he didn't want to own any more airlines. I personally think that was a little short-sighted, particularly when you know that the federal government wants to, keep not only airlines, but things like airports, ports, other things that are infrastructure in gear. We have a $1 trillion infrastructure program that's coming out here. So I think any investment opportunities that involve infrastructure of the country, travel, meeting, those types of things are probably the best opportunities because they're the most chopped up.
Great. Another question here, really digging into the point, earlier discussion about inflation, coming from George, who's doing economics at Cambridge. And George asks, with yields not pricing in high inflation over the next 10 years, what is your stance on inflation with this vast expansion of money supply? Is there a chance of deflation?
Good question. Well, as I mentioned before, I don't think the Federal Reserve's buying is inflationary by itself without lending going on. And the question is, how much lending is going on in the middle of a pandemic? So we know that the Fed's buying of treasuries and mortgages, and they are buying some corporates and munis, but those are in separate programs. But for the Fed's own balance sheet, they're basically buying treasuries, agencies, and mortgages. I don't think that's inflationary per se. I think that's more to keep rates where they are. And without lending by the banks that are basically selling the Fed bonds, without lending that out, I don't think you see inflation. I think you definitely have more inflation coming, not from the money supply side of things, which has increased a lot, but from the fiscal spending side of things. The PPP, the Main Street lending, other programs that are out there, the vast increase in welfare. I mean, think about just, if they have another round of sending people's checks. I mean, I think all of this lends itself to probably not having deflation. And as like I said, I think there's, at least in this country, there's an institutional bias against deflation and wanting to have it. Doesn't mean that it couldn't happen, but I think the chance of it is very small.
Question here about BlackRock and its how it's starting to be perceived. It's coming from Sam, who's doing law at LSE. Sam asks, with its huge size, $7 trillion plus dollars, with $7 trillion plus dollars under management, is BlackRock becoming the new old Goldman Sachs / great vampire squid? At the same time, their largest shareholder said they're selling their 22% stake.
I'm trying to remember who their largest shareholder was, Harry, because I saw the story, and now I can't think about who it was. But it's a very good question, and the answer is BlackRock is right up there. So you sit there, and I'll give you an example. Here's the Fed, here's the Treasury. They set up a program to buy municipal bonds out through 5 years. They had to be investment grade or better. They could alter the maturity part if the Treasury Secretary wanted it. But the Fed was going to act as their agent. Now, the Fed is not in the business of buying municipal securities. They never have been. They don't have that expertise. So what are they doing? The Fed is using BlackRock as their agent to do that business. Do I think, as an institutional investor, that there is a Chinese wall up between the BlackRock that's executing the Fed's work and the rest of the BlackRock, which is doing the investing for stuff? Jesus, I hope so. But that's what you hope. You don't have any confidence that they're behind closed doors, that one side's not talking to the other. So, you talk about the great danger of being too big. There's the danger.
It was PNC Financial.
PNC, right? Thank you.
Yeah, looked up. So we figured this would be a nice one to end on, because of course we're going slightly conscious of time. You've been very generous with it.
That's right.
So far. We thank you for that. It's come from Natasha, doing maths at Oxford. Natasha asks, what is the best advice you would give to budding young investors looking to start their own investing portfolios?
I would do two things. When you start, don't be afraid to buy some of the broad indices through ETFs like SPY or the FT100 or any of the other equity indices that are out there that give you broad market exposure. And the other part of it is have some fun. Buy some individual stocks. And I would say the great Peter Lynch has been retired for longer than a lot of probably people on this call have been alive. He used to run Fidelity's Magellan Fund. And later on, after he was retired, one of his lieutenants took over, who actually is a friend of mine. But the point of it being that the Peter Lynch strategy was always buy what you know and buy what you like. So he had kind of an aversion to tech because he didn't understand it. By the way, Warren Buffett used to say that. But, he would buy a drugstore chain when he found himself in it all the time. Think of like a CVS. He would buy brands that he used because he'd see his wife buying certain brands. I'll give you an example. Long ago, this is going back about 10 years ago, my daughter, who now works on Wall Street, was in college doing an internship, and she won some money in the internship. And she was going to buy a Gucci bag or something. And then she said, you know what, I'm not going to buy a Gucci bag. I just want to do some investing with it. So I said, fine, you decide. So she picked stocks that she liked. She didn't just pick them because they were in the news. She picked Dunkin' Donuts, which had just had an IPO. And I said, why do you like that? She goes, because I drink a hell of a lot of coffee, and I drink it at Dunkin' Donuts. She owns it to this day. She bought some Apple because she buys, listen, buying what you know and what you use, if you think of yourself as kind of a normal person, is not a bad way to go. So what I would do is I would combine the best of buying the broad indices to stuff that you can have some fun with, owning some stocks that you like. And hold on to them. Hold the best ideas. I mean, think about it this way. For all the dips and stuff, what's the best thing you could have ever done with owning Apple stock? And the answer is nothing.
Yeah, never sell it. Thanks very much for that, John. It's a really great overview.
I enjoyed it, Harry.
Yeah, no, I thought it was great. It looks like everyone else has really enjoyed it as well. Thanks so much, guys, for coming and for tuning in.
Thanks very much.
Yeah, please.
Look forward to doing another one of these days.
Yeah, no, you should come join us in Oxford.
I would love to do that. I really appreciate everybody's time and great questions. Thank you.
Yeah, cheers, guys.
Have a good afternoon, everybody. Thank you.
See ya.